California's housing market is crashing hard. Interest rates near 7%, insurance costs skyrocketing, and listings exploding everywhere. 10 iconic cities that once symbolized luxury and opportunity are now tanking fast. Keep watching, because what's happening here could rewrite the future of homeownership in the Golden State. Starting at number 10, we have Irvine. Designed as suburban perfection with top schools and pristine parks, Irvine's image is beginning to crack. Listings have surged over 60% compared to last year. Homes that sold in a matter of weeks now linger on the market for over 45 days. Prices dropped 6 to 8%, while monthly mortgage payments balloon to nearly $3,200, more than many local salaries can handle. The culprit? Overbuilding. Developers poured in thousands of units during the remote work boom, but now demand has cooled, remote work patterns have ended, and buyer appetite dried up. Insurance costs, soaring to an average of $6,500 a year, are shutting out many entry-level buyers. On top of that, tech companies have slowed expansions, leaving office vacancies at record highs. Still, Irvine's quality schools and low crime might lure buyers back sooner than some other cities, though those skyrocketing insurance costs may not budge anytime soon. Number 9 is Sacramento, California's capital and former escape valve for Bay Area refugees, but lately that escape plan is stalling. Active listings have ballooned by 50%, now passing 5,000 homes on the market. Median prices dropped from $520,000 to about $460,000. Hot neighborhoods like Elk Grove see homes linger for nearly 50 days, almost triple compared to 2 years ago. Why? Overbuilding again, combined with wage growth that just can't keep pace. Mortgage payments and insurance have surged, plus some buyers are even canceling contracts as rates rise. Rental landlords are hurting too, with vacancy rates climbing and rents dipping. Institutional investors are dumping bulk properties at steep discounts to exit fast. Still, government jobs and central infrastructure may keep Sacramento more stable compared to coastal markets bled dry by this crisis. Coming in at number 8 is Palm Springs, with its iconic mid-century glamour and desert heat. But those sunny days have clouded. Home values declined 10% from their peak. That $900,000 vacation home is now going for $770,000 or less. Inventory has doubled, with days on market stretching to 65. This isn't a simple sell-off, it's a systemic shift. Short-term rental income fell 14%, occupancy rates dropped, and insurance premiums skyrocketed to over $12,000 annually thanks to growing desert fire risk. Luxury buyers pull back, snowbird traffic is tepid, and city crackdowns by short-term rentals have slashed owner incomes. Realtors are even offering mortgage rate buy-downs just to stir buyer interest. The desert dream is brittle, undeniably cracked. Number 7 is San Diego. Once a laid-back luxury symbol with surfboards on roofs and palm trees swaying, 2025 brought a storm not in the sky, but inland in the housing market. Inventory hit a 10-year high, and median home prices dropped 7%. Neighborhoods like La Jolla and Claremont subprice gets anywhere from $50,000 to $150,000. What was once a seller's paradise is now a game of desperate discounting. Overbuilding during the 2021-2022 boom flooded the market. Families and military personnel along the backbone of San Diego's market are pulling back due to unaffordable payments and insurance now topping $9,000 a year. Tourism is slowing, short-term rental owners drown in costs, and downtown restaurants close midweek. Tech layoffs affecting Qualcomm, biotech, and support sectors add to the chill. Still, San Diego holds on to its weather, education, and military anchors, so recovery is possible, just not anytime soon.
At number 6, Malibu, home of cliffside estates and celebrity hideaways, is in retreat. Listings jumped 70% within months. Stunning luxury properties, once listed for $5 million, now see markdowns between $700,000 and $1.2 million. These aren't fixer-uppers, these are priced estates formerly fought over in bidding wars. Insurance premiums for oceanfront homes average between $20,000 and $28,000 annually, driven by fire risk, sea level rise, and coastal erosion. Even modest hillside homes carry high-risk flood zone tags. Appraisals often come in low. Buyers back out. Jumbo mortgages grow harder to get, and some banks completely exit Malibu. Celebrities aren't just selling their second homes, they're offloading primaries too. Investors who jumped on multiple pandemic rentals are now bleeding, with short-term rental bookings down nearly 40%. Remote work declines mean no one's clamoring for beachfront Zoom rooms anymore. What buyers want is affordability, safety, and stability. Malibu's paradise is turning into a cautionary tale. What happens when your dream home becomes uninsurable? Halfway through, at number 5 is San Francisco. Once the tech capital and innovation gold mine, today's heart of the collapse. Home prices dropped a staggering 14% since 2023. In Soma and Tenderloin, sellers slashed prices by $300,000 just to draw buyers. Condos in Nope Hill sit unsold for months. Investors are dumping properties as layoffs persist, office spaces go largely vacant, and Market Street restaurants shutter. Earthquake retrofit mandates add $100,000 or more to renovation costs. Insurance premiums explode, lenders hesitate, and many homes sit unsold, unrenovated, and uninsured. Still, pillars remain. UCSF, Stanford Research Extensions, and global biotech firms maintain some stability. But the investor exodus signals a market that has lost confidence, with equity evaporating fast. Number 4 is Venice. Once an artsy beachfront haven, popular with Instagrammers and tech expats, today it's unraveling. Inventory is up 70%. Bungalows that sold for $2 million in 2022 now sit at $1.5 million and still won't move. Climate reclassifications labeled parts of Venice as high-risk flood zones, pushing insurance premiums up over 60%. Owners of charming duplexes and cottages often face annual insurance costs over $10,000 if coverage is even available. The Airbnb gold rush has ended, crushed by strict LA ordinances, fewer tourists, and higher taxes. Bulk investors are panic selling. Rising homelessness and crime near the beach walkway push potential buyers away. As remote work shrinks and hybrid schedules rise, fewer buyers sacrifice cost and space for the Venice lifestyle. It's not just cooling off, it's cracked.
Number 3, Calabasas, Celebrity Compound Central. Known for gated driveways, marble foyers, and backyard tennis courts, it's turning into a stress test. Luxury listings nearly doubled in a year. Estates priced $4 million to more than $10 million now sit on the market with 15 to 18% markdowns and average days on market over 100. Celebrity exodus and diminishing remote work demand dry up interest. Insurance premiums for fire risk top $18,000 annually, plus expensive retrofits and mansion taxes pile on costs. Even HOAs raise fees. Developers pause new condo projects due to declining yields. High-end open houses attract no attendees. When the ultra-wealthy hit pause, you know a reset is underway. Number 2 is Beverly Hills. The name conjures opulence, but the luxury market is trembling. Inventory jumped 90% year over year. Multi-million-dollar estates face price cuts up to 25%. A $12 million property may now struggle at $9 million with zero offers after nearly 100 days on market. Foreign investors, the backbone of Beverly Hills, have cut cash deals by half. Insurance for hillside estates now costs between $12,000 and $20,000 annually, with utilities, undergrounding power lines, water reclamation systems, and drought-resistant landscaping adding up to millions in unseen expenses. Proposed mansion taxes and higher capital gains policies spook buyers further. Many wealthy families shift their wealth to Texas, Florida, or overseas. Despite steady luxury retail and hotel bookings, the real estate market wobbles badly. Will the next generation of billionaires step in, or will Beverly Hills finally crack under pressure? And finally, number 1, Los Angeles. The star-studded city now takes center stage in the housing crisis. Inventory has skyrocketed 75% since the 2022 peak. Median home prices dropped 16%, with some neighborhoods facing 25% plunges. Anywhere from Silver Lake to Brentwood, price slashes have become routine. That $1.9 million Spanish-style home from 2021 might now list around $1.4 million with no offers. Multifamily investments have gone cold. Foreign investors disappeared, Airbnb income dropped 30%, and vacant units surged. Insurance premiums top $10,000 annually, even far from the coast. Entertainment sector job losses, inflation, and energy bills compound the problem. New rent control expansions, eviction moratorium extensions, and property taxes scare both mom-and-pop landlords and big investors. The classic LA premium, the
The extra tens of thousands buyers were willing to pay for the dream is vanishing fast. The city still dazzles culturally with universities, tech hubs, and historic neighborhoods, but financially the math just doesn't add up. Median income can't cover the average mortgage, and with interest rates above 6.75%, even the modest buyer is sidelined. Los Angeles isn't just a city anymore, it's the epicenter of California's housing crash. And what happens here will ripple far beyond.
So, what's the takeaway? California's housing crisis in 2025 isn't just headlines. It's real, hitting neighborhoods, listings, and wallets across the state. 10 once booming cities now face falling prices, rising costs, and vanishing investors. If you live, buy, or invest here, the old rules are gone. Want raw, unfiltered housing insights? Like and subscribe to Housing IQ. When the market moves faster than a rocket, you need data that's truly out of this world. Keep watching the skies and those mortgage rates.